Hello everyone. So with the start of the new financial year in April 2025, I have come to you with some solution to one of the questions that I have received very frequently from my friends, relatives as well as from colleagues in terms of how much money would be sufficient for us to lead a very comfortable life post retirement and how much do we need to invest to get to that number. So for that I have taken some assumptions to do my financial modeling to get to that number. The assumptions are as follows: that I have assumed that inflation remains constant throughout the investment as well as the retirement period. So investment can vary widely across different sectors such as education, healthcare, as well as your WPI and CPI inflation. But for the sake of simplicity, I have taken it to be 6% flat throughout the entire investment as well as the retirement period. Also, the inflation has been assumed to apply only on yearly amounts and not monthly. That is, I have not taken the amounts to grow at the rate of inflation at 0.5% every month. Rather, the amount that will be subjected to inflation will accrue the inflation rate at the end of the year or the start of the next year. With that out of the way, let's get to the calculations. So as you can see that I'm recording the video on 14th of April that takes the current year as 2025. So this model is very much relevant and will remain so for the entire future of your career or your life, given that whenever you open this Excel, it will show you the current year and it will show the year of valuation at which point you are doing these calculations. You can of course change the year from here directly just to check the valuation at some future point of time or at some point in the past, but that is not the goal of this exercise. So the inflation, as I explained before, has been taken as 6%. The retirement age or the year of retirement that I have assumed is 2050, 25 years from now on. You can change this and you can see the changes in numbers based on this input. The target monthly pension that I have taken is 2 lakh rupees. This amount is as of today, standing today, and doesn't have anything to do with 2 lakh rupees in 2050. So this amount, 2 lakh rupees standing today, will accrue the inflation rate in order to get to 8,58,374 rupees at the time of your retirement in 2050. And I have assumed the lifespan post-retirement to be of 25 years. That is, the pension is required till 2075, that is end of 2075. The return on investment on annuity amount has been assumed to be 8%. What does annuity mean? It means the plan that you are supposed to buy at the time of your retirement based on your total investment corpus that will give you relatively safe rate of return throughout your retirement period. It also means that the plan will allow you to do systematic withdrawal plan. You will be enrolled under an SWP. Generally, India mandates you to buy the annuity from any insurance company. In later years in the future it might change, but that's how it is right now. So with 8% you will be able to withdraw some amount in your bank account every month like pension, and the entire corpus has to be deposited with the company, with the AMC or with the insurance company, accruing 8% per year on a compounded basis. To get to that target annuity amount, which I will come to in a minute, the target rate of return for current equity investments till retirement, I have assumed it to be 12%. This is very moderate and very conservative, in line with the historical average rate of return from equity investments, which tend to lie between somewhere around 13.5 to 15% across emerging markets and in developed markets as well, developed markets being slightly lagging. But even if you are investing in foreign markets, in any emerging or any developed markets, you are quite safe to assume 12% return from your equity investments. The rate of return on current NPS and EPF and NPS accounts. So this is relevant for those people who are employed currently and are expected to receive EPF contributions from employer as well as it is expected that your salary will be deducted by the EPF amount every month. Also, you can invest in NPS, National Pension Scheme, as well as you can invest in PPF. So altogether, what I have taken a moderate rate of return from these kind of investments to be 8%, and that is the entire range of investments that we are talking about: equity and safe investments. So this investment EPF NPS category can also include any kind of debt investments, for which as well 8% is an achievable number. The percentage of equity investment that I have considered is 70, because if you are in your early 20s, late 20s, early 30s, late 30s, early 40s, you are expected to invest massively in equity, because it is giving you 4% return on and above, over and above your investments in EPF, NPS, your debt investments, gold investments, etc. So you are supposed to overweigh your equity allocations, and that's why I have considered 70% over here. The annuity post-tax, what does it mean? So as I explained before, the amount of deposit that you need to make for the annuity is 19 crore 82 lakhs 40,856. What does this number come from? This number comes from the pension amounts that you are going to receive every month, that starts from 2050. In the year 2050, the amount that you are going to accrue every year, or you are going to withdraw every year, is this amount, right? So 1 crore 3 lakh 490 rupees, and it will continue to gain in number in terms of to the tune of the inflation rate. So it goes finally in 2075, you might be required to withdraw 4 crore 42 lakhs 8,370, given the inflation rate at that point of time. So all these numbers, the yearly pension amounts that you are going to withdraw, has been discounted back to 2050, not today. It's discounted back to 2050, because that's when you have to deposit this money with the AMC or the insurance company from which you are going to buy the annuity, right? So this is the amount that you are going to deposit, but to get to that you have to pay some tax on the investment. So I have taken a flat hybrid tax rate on the long-term investment. This is the LTCG rate that I have taken, the long-term capital gains tax, to be 15%. Right now LTCG is at 12.5%, but given the way that government has been raising LTCG tax rate, I have bumped it up a little. So that's how it is. And the pre-tax annuity amount comes to 22 crore 27 lakhs 29,432. To get to that, how much amount do I need to have in my bank or in my investment accounts right now? So what I have assumed is I have 10 lakh rupees. You have 10 lakh rupees in your investment accounts all across all asset classes. It includes equity, it includes NPS, EPF, it includes bonds, it includes gold, everything. So this is your initial corpus. With that being in mind, let's get to the equity SIP required per month. When I say equity SIP, it can include both mutual fund SIPs as well as any stock investments that you might be doing at this point of time in a staggered manner. So you can do SIPs in stocks, not in a very systematic way, but if you want, you can choose to invest in stocks every month whenever market dips a little. So that's what I mean by SIP in stocks, and both combined you have to 72,450 rupees every month in equities. And in EPF NPS, so this includes debt, gold, whatever other than equities, so that comes to 62,540. All of these have been calculated keeping in mind your target allocation at the time of retirement 2050, which is 30% and which is 70% equity and 30% all else. That comes to your total per month investment 1,34,991, which seems quite massive at this point. But hey, just take a note of this amount being a flat amount throughout your investment period, 25 years, 2025 to 2050. So this is not actually increasing with your increments, with your any other income that might come in the future, any bonuses that you may receive every year. So this is a flat amount that stands at 1,34,991 today, and it stays the same overall over the 25 years period. So let's, for example, check what happens if I increase or decrease the retirement period. So let's say I decrease the retirement, I pull the retirement year to 2045, then my total per month investment goes up. And then, for instance, I'm happy with per month pension being 1,50,000, because hey, of course you will not have any loans to run, you generally won't have any big responsibilities probably coming up after your retirement, your children's education should be taken care of. So 1,50,000 is also a pretty decent number. And then it comes to 1,32,000, and then if you move the retirement period back to 2050, now it's under a lakh. So that's all it takes, investment of under a lakh, to get to your pre-tax annuity amount of 16 crores 70 lakhs 47,000. So that's what I wanted to get at, that what is your current monthly pension. That's something that you need to decide, and then I can give you the number that you need to invest today. So that's all it is for today. I hope you had enjoyed the video, and this video could bring some value to your investment and your retirement planning. Let's call it a day for now. Let's catch up in the next video, and if you have any questions, if you didn't understand something, or if you have any suggestions or feedback, please don't hesitate to put a comment or message in the YouTube channel, and I'll meet you in the next video. And if you like what I'm currently trying to do with this channel, please give it a like, and please share this video with everyone that you know who you think might be benefited with this kind of videos, and please consider subscribing to this channel. Okay, bye bye.